The next thing I want to talk about relative to that is a little bit of an aside, and that is the current market exuberance in equity markets and private debt markets. We've had a rebound. We've had a rebound in the equity market since, I guess, early March, and we've had a rebound in the public debt market since, what, December, Joel? Like December 2nd, I think was the low?
December was probably the bottom. And then December was probably the bottom. Spreads were about.
Okay. So the bottom on the public debt markets, namely junk bonds, AAA bonds, in other words, the market debt of U.S. corporations, kind of hit the bottom in December. The stock market hit the bottom in early March, and there's been a pretty strong revival. And the question is why and what to make of it. What is the market trying to say? And it was somewhat perplexing. And myself, particularly as an economist, found it extremely perplexing because if you take a look at the underlying strength of the financial institutions, it's terrible. You take a look at the economy, it's continuing to melt down. And what we simply had was what seemed to me some irrational exuberance. But actually, taking a step back from it, I felt it took a month or two for it to sink in, I think, as to what rational. There was a rational part of it, of this market rebound. And the reason the market rebound occurred is it's somewhat the next step to this last discussion. As we had the financial institutions melt down, and they were continuing to try to shrink their balance sheet, and they were selling assets to do so and cratering prices to do so. But another thing they can't do with insufficient capital is put new assets on the books. So it turns out that their clients, who were their client borrowers, were left in the lurch. And the ones that were specifically left in the lurch were a lot of companies, irrespective of quality, the whole quality spectrum. If they had debt coming due over the horizon, they knew they walked back into their bank. It was not that loan was not going to be refinanced. It was not going to be rolled over. So basically, we had a situation where cash ultimately really became king, because if you didn't have sufficient cash on your balance sheet relative to debt that's due shortly or quickly, it's a shortcut to Chapter 11. You can't service the debt, and you can't get any more cash because they're all out of the lending business. And you can't go to the public markets. The public markets were totally frozen until about March of this year. So you couldn't refinance any debt that was coming due. Now, so what that meant for so many companies, including the most esteemed and the least esteemed companies, if you had debt due, it was a shortcut to Chapter 11, i.e. to take bankruptcy, seek bankruptcy protection. So what we had was a crushing down of debt prices, of private debt prices, and we had a crushing down of the equities, because in bankruptcy, the equity doesn't come out with much, if at all. And basically, we had a lot of companies that were strained for cash with debt due, where their equity valuation was what finance people call, quote, an option value. Namely, we saw the franchise, which fundamentally is a fine franchise if the economy is rolling and they had a balance sheet that would not put them under. The valuations were no longer based on the ongoing franchise value, but on liquidation value, with the expectation there would be liquidation. The only reason there were positive prices, there's always the possibility of, quote, a Hail Mary, that something from somewhere will come about to help us out, and it did happen. And it happened in the form of Ben Bernanke and his colleagues at the Federal Reserve turning on, I don't want to say the printing press because that gets into next lecture and I don't want to have premature conclusions of inflation. That's one of the issues that will be discussed next time. But they turned on the printing press and they loaned money not only to commercial banks, who, by the Federal Reserve Act, they are allowed to do so, but they went beyond that allowable authority, and actually there was a catch-all authority in the Federal Reserve Act. It's called, I think, Section 13B, I believe. It's called 13B. If they're, in their opinion, there's extraordinary events, they can do whatever the hell they want. And they evoked 13B day after day after day after day. Only once ever before ever evoked, which was in the Depression. So we went into depression regulation. Basically, they had carte blanche to do what they wanted to do. I believe, I haven't read it in a while, and I can't recall if they have to ultimately get the president's approval or they simply could do it themselves. But they certainly informed the president. In fact, every one of those over-the-top events last October, there'd generally be a press conference where Ben Bernanke would say what he's going to do, and this press conference is at the White House. Well, the Federal Reserve never goes to the White House because they're an independent agency of government, and to make that point, they never go to the White House because there's a sense that they're getting instructions from the president. So every time Ben Bernanke showed up in October or November of last year at the White House, you know he's informing, at a minimum, informing the president, if not also getting his authority to use Section 13.B. Now, what happened, what they did, the Hail Mary that saved the corporations that had debt coming due, either bank or either a commercial bank debt or public market debt, either way, what the Fed did was go beyond the Federal Reserve Act, where in the Federal Reserve Act, they're only entitled to lend to member commercial banks that are members of the Federal Reserve, which are a very small number. They're only about 400 out of about 8,000 banks, I think, currently that are members. And then they will lend to the members, who in turn would lend to non-members. So you can use Fed money to get it down to state banks in Texas and everywhere else. What the Fed did is it started lending to non-commercial banks, other financial institutions, to help them in their meltdown, so that when the margin calls were coming, instead of having to sell assets further, they would just go to the Fed and borrow the replacement loans. So the Fed was stepped in not only with commercial banks in a big way, they stepped into any other financial institution that was not a commercial bank, and included I-banks and ended up including hedge funds, and included everyone. And matter of fact, not only U.S., but foreign as well. So, I mean, we're so far over the line at this point, I'm semi in a state of shock. Having started my career at the Fed and almost at one point having to memorize the Federal Reserve Act, they were in uncharted waters, absolutely uncharted waters. Then on top of that, about a week or two later, it really shocked me even further, in that instead of just lending to financial institutions to keep the meltdown from progressing, they started to lend directly to U.S. corporations. Because what happened was the commercial paper market froze up. Now, the commercial paper market is short-term, high-quality debt. It is unsecured, so it's only the highest quality corporations could step up to the bar for commercial paper. The thing about the commercial paper is it's unsecured lending, and the maximum maturity in that market is, I believe, 9 months, but it's usually 6 months. And these are the top corporations. This would be Ford, and it would be General Motors, etc. And so the Fed enters into this market and starts to buy the commercial paper. So basically now the central bank is not just financing non-commercial bank financial institutions, it is now financing U.S. corporations directly. Now, effectively what happened is the Fed stepped over a major line. It became a private bank. In the whole history of the Fed, which goes back to 1914, we're almost 100 years there. We're about 5 years short of 100 years now. They never loaned to a corporation, a private corporation. It was always a member bank, or or very short term for some extreme reason during the Depression. But the point is, the Fed stepped over the line and became a private bank. Just as our private banking system was shrinking from the implosion of the values going away and the withdrawal of the funding, the bank regulators continuing to enforce the minimum capital ratios. As that meltdown proceeded, and we didn't have the usual banks were no longer banking, so the corporations couldn't get loans from them. So basically, they went to the Federal Reserve. And the Federal Reserve steps up and becomes a private bank in competition with commercial banks in this country. So basically, we have a new Federal Reserve. The assets, and next lecture I'll bring that in, we'll look at their balance sheet. They were the biggest lender. They added $1 trillion to their balance sheet in a couple of weeks. They got very quickly to a footing of $2.1 trillion. So, and this happened in a matter of weeks. So they became the de facto lender in the financial markets. Now, how did this affect the corporations? Well, all the corporations who last fall were being traded on the basis of the shortcut to Chapter 11 and what are the values of debt and equity in bankruptcy, suddenly have a source of money. And basically they went to the Fed and borrowed the money as a substitute for their bank, and now these corporations got tied over. Some of course didn't make it, like General Motors and Chrysler, but Ford did. So some made it and some didn't. The great majority of them did have access to cash, so they didn't take the shortcut to Chapter 11. That still might lie ahead as the economy goes into recession, but that was avoided. And furthermore, what the Fed did in the Great Hail Mary was they put an end to the meltdown of the financial institutions by having pretend capital and lending them to keep them from shrinking. So the Fed did two major things. They kept the corporations afloat and they kept the banks afloat even though they were insolvent. So now what happened is the market came to realize that the valuation of companies on the basis of how much will these claims on this corporation be worth in bankruptcy, now they start to see that they have some possible future ahead. So basically what's happened is this rally in the stock market since March 2nd pretty much centered on the option valued equities, and basically imminent bankruptcy was taken out of the picture. Now they're getting valued on another basis, and the basis they're getting valued on now is a company that's in a deep recession and how will they do. So we went from bankruptcy valuation to deep recession valuation, which was a big improvement over where they were. Now I think the number was something like 35% or so increase in some of the stock indexes of the last few months. And if you take a look at who in that index rallied, it tended to be the option value stocks, not the solid companies with cash, with an ongoing franchise value. And that's one of the great ironies of this is the first to recover was the worst. Or I wouldn't say the worst so much as the ones who were not financially capable to make it through because they put themselves in the hole by having too little cash on their balance sheet and too much debt. And so therefore we've had this rally. Now there's something else that has gone into this rally that I just want to mention for a few minutes in passing and then get on to the main subject of the second lecture. There's something else that happened that rarely happens to this extreme. And I guess the best way to say it is we have had a major departure of expectations in the market from the underlying reality. And if you think about financial markets, you buy a stock today, and you're buying a stock today because of the income you think it's going to produce in the future. Well, how are you going to value that? I mean, that's all expectations. That's all a kind of Hail Mary. We think it's going to do this. And the same thing with debt. I mean, because what's going to support the debt of the company is the cash flow and how well are their products going to be received in the market and what's going to be the economic circumstances. Will they be able to, like Apple, sell their new Apple and generate the cash flow? So basically, it's all expectation. What we just have had a major departure of expectations from the underlying reality. We've had a post-war period from 1946 till until 2007. So that's 62 years of a period of time, as you'll see in some of the handouts today, where we've had prosperities and short recessions. The Fed turns on the gas, takes us out of the recession. We have another prosperity. 3 or 4 years later, we go down into a little recession. And if we're lucky, then it lasts 7 or 8 years, and then we have another little recession, etc. So most of the people in the market have expectations based on their own history of observing that when the Fed gets active in the market and supports the market, we get out of the recession and we're back to prosperity. All day long, I hear this on CNBC, and basically the only reason I listen to CNBC is to try to pick up expectations. And you hear that voice over and over again. It sort of goes like, well, I've been in the stock market business for 30 years, and I have seen time after time when the Federal Reserve turns on the gas that it takes care of all problems, and the economy turns around. And yes, it's terrible right now, but remember that on average, the stock market turns up 6 months before the economy turns up. How many times I've heard that expressed in one form or another. If I had $1 for each one, I wouldn't be here tonight. I'd be in Hawaii.